Welcome back to the Dynamic Growth Podcast. My name is Nate Crosby, and I am joined with the University of Ohio State's finest, Derek Ballinger. Derek, today, what I want to talk about is something that is in the news right now, but it's been around for a very, very long time. And if I look at the traditional evolution of what some businesses take, some very successful businesses are an entrepreneur or a group of individuals start out with an idea, and that idea grows into a business. The business becomes successful, it grows, and maybe if they have the resources and they have the structure, they might even finding themselves with a decision to go public. And when a business goes public, there's typically a it could be over a year's time of grueling regulation that takes place that the directors need to go through to show that this company is acceptable to be a publicly traded company. But then what we're seeing on the other end of things, there's a company, a type of business that's known as a special purpose acquisition company, otherwise known as a SPAC. And these SPACs do not have any products they're selling. They don't have any products they're making. And really, the only assets they have are the assets they bring to the table that their investors bring to the table to invest in the SPAC. And so I want to talk today about what is a SPAC and why the heck do we care if we are investors.
If you like the episode today, make sure to follow us on Instagram at Dynamic Growth Pod. Like, review, and subscribe to wherever you get your podcasts. Comment on YouTube, and let's get into it.
Well, Derek, for our investors that maybe have never heard of a SPAC or a special purpose acquisition company, can you maybe shed a little bit of light and maybe give us a definition of what that is?
Yeah, so I think a good place to start is to address why a company would want to go public in the first place. So the reason, like the traditional route of going public involves what's something that's called an initial public offering or IPO. And we talk about those a lot on the show. But basically, like you said, when a company goes public, they are looking to raise more money, raise capital for the expansion of the business. And so an IPO is the first time that shares are offered to the general public to be an investor in the company. Not all large companies that we think of are all publicly traded. I'm trying to think. I looked up a list of private companies, and there weren't that many of them because most of the companies that we interact with day to day. I mean, your local restaurant is not a publicly traded company. It's not traded on the New York Stock Exchange. That's a privately held company. But if like a company like Apple, where you can go out and buy shares of Apple's stock, that's a publicly traded company. But so there's an immense cost with initial public offerings. And then, like you had mentioned before, there's a lot of regulatory red tape, and they can take like 6 months to a year. But the way around that, so in 1993, GKN Securities crafted a template for a company to go public without all of the regulation and all of you're basically going into deep waters in a world that you're not familiar with. If you're a technology company, you don't know the ins and outs of Wall Street. So a company might go public via SPAC or special purpose acquisition company. And the way that it works...
Say that fast.
Yeah, right. Say that 10 times fast. And the way that it works is usually a company or private equity firm or some sort of investment vehicle will have an initial public offering themselves, and the company will have no operations, like you said, and their only purpose is to be acquired by an actual company that makes a product or sells a service. And so the SPAC will go out and raise money via the IPO. And one thing to note, in the IPO of the SPAC, the investors that are investing in the IPO, they don't know which company that SPAC will go out and merge with. So oftentimes they're called blank check companies. I feel like we're going to get tired of saying SPAC. I feel like I've already said it 50 times.
Blank check company sounds a little bit more, little easier.
Yeah, right. But a company might choose a SPAC rather than an IPO because, you're basically walking hand in hand with an entity that has been through the process, and those will sorry. Those will typically happen faster than an IPO, and you don't have to do all of the regulatory work. And also, when selling to a SPAC, there's usually a premium being paid for the company compared to a traditional acquisition, so smaller companies can take advantage.
You really have to, if you are, I guess what I look at this from is from an investor's point of view, the retail investor. And why should they care if a company goes public by merging with a SPAC or if they go public on their own? So I see a trend taking place, and I'm going to get into some of these things that may or may not be related, but I think I can piece them together. So you would mention it's a blank check company. So investors are coming forth and investing in this SPAC without knowing what other company they're going to merge with, right? And usually that period of time is anywhere from 18 months to 2 years. Usually 2 years is the longest. And then at the end of that 2 years, if they have not found a suitable company for which to merge with, then the investors typically get their money back plus whatever interest is earned. Because when these investors give their money, a lot of times that money is held in a interest-bearing account until they're able to pull the trigger on a company that they find suitable to merge with. And when they do, there's going to be a voting process. So they will vote to see if they want to exactly merge with that company. It's important, like you said, the company that they're looking to bring public, the SPAC is looking to bring public, essentially merges with and into the SPAC.
Right.
And then those investors have the option of swapping shares, or they could also redeem if they wanted to, and then walk away out of that. But the type of people that you find investing in a SPAC, in a blank check company, is Wall Street professionals. They could be hedge funds. They could be CEOs. Richard Branson is somebody who has invested in a SPAC before. The thing that you have to be careful of, there are examples of companies that have gone public through a SPAC and have been highly successful. Now, they're still relatively new. The one that comes to mind is, so far, DraftKings has had a pretty remarkable run as a publicly traded company. They went public through a SPAC. But for each one of those DraftKings that I find, I can also probably find, yes,
yeah, right.
Nikola Motors. And even if you look at, so Virgin Galactic was a company that went through publicly traded for a SPAC, and for a while it did very well.
Isn't that Richard
Shares
Branson's
have fallen.
company? You had mentioned Richard. Yeah,
it is Richard Branson's company. Yep. Shares have fallen from 54 to 23. Open Door is a one that went through. Do you know what Open Door's concept is?
They do reservations, right? Is that reservations?
No, I think this one is. Maybe they do that also, but I know what their technology that they lean on is the ability to sell a home without actually having to physically be in a home, because their technology.
Am I thinking
allows
of
you to
Open
walk through this
Table?
home.
Are there some?
You might be thinking of
Oh,
Open
okay,
Table.
sorry.
Yeah.
Yeah.
Open Door, neat concept,
Right.
right? But shares went from 34 to 18, as you mentioned. Nikola Motors collapsed.
Yeah.
Now, I don't know if that's purely related to going public with a SPAC. I don't think it is. I think it's the company itself. But the point I'm trying to make is, and I have some hypocritical thinking here, and I'm going to talk about that a little bit later. I admit that I'm hypocritical in this. Sometimes the rigors that a company would need to go through to become publicly traded are good for the investor. Mm. What comes to mind is a company called WeWork. Do you remember that one?
I had a bunch of notes about WeWork. I wanted to talk about that. Yeah.
I'm going to let you take it away then. But the thing that I would note about that is, so WeWork tried to go public in 2019. It imploded. Didn't work, right? And for all the right reasons. It didn't work. Now they're looking to go public through a SPAC. So basically they're looking to backdoor that IPO, which again, I mean, maybe some regulation on here, a little bit more regulation is good for investors.
Yeah, I mean, WeWork, they were like basically a laughing stock in 2019. They kind of fell flat on their face with a really embarrassing public IPO where they would have these crazy lofty valuations, but nobody really knew what they did. And they were exposed very quickly. Before they could go public, they had filed to go public and were about to go public, but they had to pull it because of all this negative media exposure. And yeah, like you said, they're planning to backdoor it via SPAC. And but it seems like recently, you're right, there has been a little bit more. I'm talking about recently as in like a matter of weeks, because like the SPAC phenomena really took off in 2020. Hold on, sorry, I had some notes. Yeah, there were 165 SPACs, and then there were 165 SPACs in 2020, and they raised a total of $82.1 billion in 2020. And typically, like when there's this much hype and excitement about something involving investing, that's usually cause for skepticism. But like in Wall Street, they usually have a tendency to double down. Like the riskier something is, they'll double down. And in the first 4 months of 2021, SPACs have already raised $87.9 billion. And the problem with that is, like, if there were that many good companies out there, this wouldn't be a problem. But the thing is, like, to place $88 billion of capital, there has to be good companies to receive it. But there just aren't $88 billion worth of good companies out there to be invested in.
So let's be honest, a lot of this is just a money grab
Totally,
taking place. And so we had a client who's an executive of a company in our office, and they were pursuing going public through a SPAC. And after about 6 months of going through and finding out if this is a match, what they ultimately decided was, at least for them, there was too much negative publicity about companies going public through a SPAC. I mean, companies that had no business going public. Right. Startups that just did not have the revenue, did not have the structural base.
Nikola hadn't even made a car yet. They hadn't even sold a car, made a car. Right. It wasn't even a proof of concept. They didn't even prove that they could make a car, and they got a $700 million valuation. So
think about that. You have a company in the SPAC which has no product,
right,
purchasing or merging with a company that has no product, and bringing this to the open market for investors to invest in. So my hypocritical thinking here that I'm going to get into later, but let me lay the groundwork for that. I am for some rigorous due diligence for a company going public, because I think that allows investors to see the product, to see their management, to see their history of returns and projections going forward. And some of these companies will do creative things with the books. Let's take a look at that and see what's taking place. Is this something that they're trying to fluff up and make look as good as possible? Kind of like we talked about last episode, where you're selling your car, you give it a polish, you spray it off. You're trying to make it look as good as possible, or is this a company that can stand on its own?
Yeah, I think I think it's the business regulations have such a complicated issue. But as far as regulation on Wall Street, I agree with you, because and I don't like generalizing here, but I don't think Wall Street hedge funds should be the moral police of our society. Like, these aren't the most upstanding citizens. These are just money-hungry, greedy individuals that are just trying to make a quick buck here. I don't think we should. I don't have a problem with these people being regulated, but it's more so like when small businesses get as much scrutiny as like a Wall Street hedge fund. That's what drives me crazy. It's like.
For sure that does. Let's be honest. You and I love this profession because I find money fascinating. I don't find money evil. I find money as a source of value. It's a source of good. I get paid because I'm providing value to somebody else. So money's a great thing.
Yeah.
And I like to make money.
Yeah. I mean, I studied economics for a reason. I agree with you. It's not just like money itself, but like the whole monetary system, the financial system. It's really fascinating. Yeah. It's
fascinating. So let's be honest. We talk about investing all the time, and we're here to make money, right? But we also want to make sure that we're preparing what we're doing so we don't get burned. And what I see with this, you had mentioned there's all these companies, all this money out there to looking to make companies go public, and there's just not enough good companies out there. But there is such a craving right now for IPOs. I mean, look at some of the high-flying IPOs that went out and what they were offered. I mean, Coinbase recently went, right? The valuations of Coinbase. Airbnb, which I think is going to be a quality company for years to come.
Yeah, they had a really, really crazy valuation.
What was that? I'm sorry,
Snowflake. Snowflake had a really crazy. It was the biggest IPO in history.
Yeah, I mean, so the hunger for growth is crazy. And so here's a link that I look into. I see these IPOs. It's almost as if in recent times, this has been around forever, but maybe it's because of everything is so virtual nowadays and quick and responsive. We see IPOs that everybody wants in on. We see cryptocurrencies. And let's face it, some of the cryptocurrencies out there are complete garbage.
Yeah.
That doesn't mean that they can't go up in pump and dump schemes. I mean, look at GameStop. Are these related? Not directly, but I think the idea of them is related in the sense that I can go out there and I can make a quick buck.
Right. I mean, but the thing with those are, yeah, you're absolutely right. Those are all separate individual things. Like the reason Dogecoin went up was a different reason than why GameStop went up. But sorry, I have to correct myself. I said Snowflake was the largest IPO. It was the largest software IPO, I believe. Do you know the largest IPO in history?
I do not.
It's Alibaba. I was surprised. Yeah,
is it really?
Alibaba's the largest IPO.
What about, and maybe it was an IPO. Do you remember when the Saudis were making their oil? Was it the Saudis? I believe making their oil go public.
I'm not sure.
I thought that was a giant one. I can't remember the name of that IPO, but
I think Alibaba was 27 billion in an IPO.
Yeah, it makes sense. Makes sense.
Yeah.
So as investors, I think there is actually a database out there. The abbreviation is EDGAR, EDGAR, and this is the Electronic Data Gathering, Analysis, and Retrievement. And you can get on to investor.gov, and you can actually look at these SPACs, because when you buy a company that is going public through a SPAC, what you don't have is a lot of information about the SPAC itself. And the SPAC may have 20% ownership in that company, right?
Yeah.
So it's something that you want to take into consideration. What this will tell you is what are the terms in which, if they're swapping their shares out for shares in that company, what are the terms of that? Because maybe they're able to receive those shares for much, much less than you could receive them. You also want to know the management background of these people that are going to be have a substantial ownership in that company that is merging in with them. What is their management experience? Are they coming from a series of disasters, and this potentially is one too, or do they have somebody like Richard Branson who actually has a successful history as an investor?
Right.
That's something you can take a look at as well. It requires a lot more digging. SPACs tend to go public much quicker than what a traditional IPO would go, and there's less regulatory action. There's less rigor as far as that process, which comes with the good and the bad.
Right.
I guess just be careful.
Right. And we talked about when Snowflake was going public, and I think there's another one, but we had mentioned, and we talked about this before in another podcast, where you kind of have to, there's an exception to every rule, but it's usually best to let the company exist in the market for a couple quarters and see how they hold up, like on earnings calls, hold up against the analysts, and then decide if it's something that belongs in your portfolio. I mean, outside of that, a lot of IPOs are quick, like turning a quick buck, like swing trading. And we also talk about all the time, all of the good shares are already picked up by the institutional investors. Like what's offered to you on the day of trading, like that first day of trading, is like the highest valuation that they could have possibly gathered up. But
you're late to the dance.
Like way late. Like you showed up when the janitor's cleaning up. Like, yeah, you're way late to the dance.
Important to note, think about some of the great companies right now. Let's look at Apple or Amazon or MasterCard or Microsoft. What if you didn't buy them at their IPO, but what if you bought them 3 years later? What if you bought them 4 years later? Like, you've made a ton of money, and you've got to see them operate in the public environment, in the public arena, and you've got an idea to understand their management, what they're trying to accomplish.
Right. If you factor
much safer.
Right. Sorry. Yeah. I was just gonna say, like if you factor risk into your profit equation, then you could argue that you actually did better off in scenario B, where you waited, because you took on a lot more risk investing it in the IPO rather than letting it exist for a few years.
Yeah. Derek, are we able to switch topics here, or do you want to hit a little bit more on SPACs?
I think we did a pretty good job. I know what we're going to talk about next. And before we talk about Bitcoin, I wanted to address the elephant in the room of Dogecoin, because I recorded that podcast. Like, we record these podcasts a week in advance. So I recorded that podcast about Dogecoin when it was at 8 cents. And then literally the next couple of days, it shot up to like 49 cents. And I pretty much made the case that it was a slot machine and you probably shouldn't buy it as an investment vehicle. And it's still sitting at like 3x from where I record the podcast. So hopefully I didn't lose credibility as the crypto expert, but I was...
No, you gained credibility. Here's why.
Okay, go ahead.
Here's why. Because what you stated was Dogecoin was like pulling the lever on a slot machine. And that's what happened. There's nothing about Dogecoin that makes it a solid long-term investment. Right?
Or even a solid
there's nothing
crypto.
there.
It's not even a good crypto. Yeah.
Even a solid crypto. There's nothing there. So can money be made on it? Absolutely. You can make money on selling, baseball cards. You can make money selling. There's lots of things you can make money selling on, right? And the other thing that you can't underestimate, actually, baseball cards would be more solid, I think, than Dogecoin.
Yeah.
But
NFTs.
I don't think you can underestimate mob mentality, in the sense that we saw that with GameStop. We saw that with we're seeing this with Dogecoin, in the sense of if enough of the public gets behind something and the hype is there, the hype itself can drive it up, right? And it might prop that up, but there's nothing there, like GameStop, there's nothing there to keep
Especially in the age of the internet, when
Sure.
the velocity of information is extreme, where and
Right.
especially when there's like when you factor in like meme culture and how it basically becomes like a joke, and it's a joke that you can make money on. That's like the best kind of joke, and it's a joke.
Right.
To add one more layer, it's a joke that you can make a lot of money on, where you get like 10x upside with just putting in $20, and anybody can take part in this, and everybody has the tools to take part in this, and then you see your buddies and everyone's talking about it, and then we do a podcast on it. It's just it's a crazy time when you factor in the internet. It's almost like a lot of this stuff is inevitable, and then you factor in like Reddit and how we just went through COVID and everyone's spending all their time online. It's just kind of a perfect storm for a lot of this stuff, even to tie it back into SPACs, where like some of these crazy valuations, it's a crazy time to be an investor for sure.
It really is. And I was talking to my father-in-law about this, and he kind of brought up to me about it's almost like this gambling mentality, where we are bleeding in right now the difference between gambling and investing. Somebody will think that gambling is investing. It's not investing. This podcast is about investing. This podcast is about creating and being able to sustain long-term wealth over time. It's not about what is the next thing that's going to make me a couple $1,000 tomorrow, or a couple $1 million in 6 months. That's
or
not
a couple
what
$1 million
this is
in
for.
a couple of days, depending on how much you put in.
Right,
Yeah,
exactly. Exactly. And I'm not saying that you shouldn't do that. And we were talking, him and I were talking, actually, I mean, I do that. There's a segment of my money, and maybe in different things that most people would recognize, but there's a segment of my money that I put into things where it's not my retirement. It's not going to pay my mortgage. My kids aren't going to miss a meal. It's money that I have on the side that keeps it interesting. And sometimes you might buy a stock, or you might buy an investment in something that is just fun, right? It's fun to follow, fun to track, and there's nothing wrong with that. But when you get on the Wall Street bets, and these people are putting up these sums of money that they have no business putting up, because if it crashes, they're ruined. That's gambling. That's bad gambling.
Yeah, like I read stories of people buying into GameStop when it was at like the $300 a share, and they were putting in like $50K that they took out like on their second mortgage.
A loan for it.
Yeah,
right.
And then so you add in the leverage, or it's like you might never get out from under that. It would take you. That's like financial ruin for decades. Like depending on your age, like it might be the case where you never get out of that. And it's really
think
sad.
about that. So,
sorry, go. Yeah, you're good.
You take out a loan, right? You take out a mortgage, line of credit on your house, to put down on GameStop, and you got in on the wrong time, which most people probably got in on the wrong time.
Most people lost money for sure.
So they lost a lot of money. So what's your solution? Maybe you can't pay it off. So you have to come up with this again, right? So maybe the next.
I mean, that's gambling.
Next scheme
that's
is
gambling.
Yeah, that's gambling, right? That's Gamblers Anonymous. Like, go ahead and dial the number, because you're going to find yourself in a hole. This podcast is not about that. But what I wanted to get into was some hypocritical thinking that I realized that I had. I had just mentioned that I am pro-regulation when it comes to a company going IPO. And I think that is for the protection of investors. And then I was reading over the weekend, Bitcoin has fallen a little bit. What is it now, Derek? Somewhere around 55?
Yeah, 55. I think I haven't checked it since we started, but earlier today it was 55.
Okay. It was at 63, and then it fell down to 60. It was about a 4% drop when it fell down to 60. Part of that was the news that Turkey came out and said that they were banning the use of Bitcoin for transactions, or not just Bitcoin, cryptocurrency for transactions. And some of the things they cited were that there were no regulatory mechanisms, there was no oversight authority in place, and that they also felt that using cryptocurrency for transactions undermined the current monetary system that was in place.
I can't find a place where they're wrong. I
What's
can't
that?
find a place where they're wrong. I think
Because it does.
I think they're right on all those points. Yeah.
It does, right? But so what I love about this podcast is you and I have become good friends here over the past year or so, right? And this is not a political show, but if somebody were to, I guess, dig into me as far as my typical thoughts on things, I'm probably a little bit more right of center than you are, and you're probably a little bit more left of center than I am. Would you agree with that?
That's pretty accurate, yeah.
Right. So I think we are hope for America, Derek, because
Yeah.
we can agree on things and we can have intelligent conversations, and I think it strengthens us because you come up with something that maybe I never thought of before, and maybe every once in a blue moon I will offer something that you haven't thought of before too. So I'm a guy who is usually pro people, pro power to the people, less regulatory, less centralized, more decentralized. I'm that type of guy. So when I saw this thing out of Turkey, I was rooting against it because why was I rooting against it? Well, I was listening to an interview with Terry Cohen, economist Terry Cohen, and he had said that if he were a betting man, that he couldn't see a situation where the Biden administration would not go after controlling Bitcoin, trying to put some sort of regulatory action on Bitcoin. And that saddens me a little bit because the thing that I love about the idea of Bitcoin, it is decentralized, it's power to the people. So that's my hypocritical thinking there. At one end of the spectrum, I'm for some regulation on stocks going IPO, but on the other end, I see governments getting involved in this. So Turkey says it's a threat to their current monetary system. It absolutely is.
Yeah.
But maybe we do need a threat.
A disruptor.
A little bit of a threat. A disruptor to the monetary system.
Yeah. I think maybe there's an omitted variable in your analysis there. I think the intention is. I think intention matters a great deal because with crypto they're doing it to protect the status quo. I realize that I'm biased in this too because I'm pro crypto, but they're doing it to protect the status quo, protect their monetary system, and then in this situation with SPACs, they're kind of doing it to protect the macro economy, that it doesn't form into a bubble, or protecting retail investors from investing in these. It kind of goes back to your point of people versus institutions, and which one do we value more?
Yeah, I see that. I also see, I guess the right word is not protectionism, but obviously they are trying to maintain the status quo, right? And there's a lot of people that benefit from maintaining the status quo.
Yeah, a lot of powerful
Because
people benefit from it.
A lot of powerful people benefit from maintaining the status quo. But if I look at, let's say here in the United States, cryptocurrency and Bitcoin is the popular thing right now. And the means to regulate it, in part, is a means to protect the people for sure, but also maybe maintain that status quo. When I look at cryptocurrency, it is definitely a threat to fiat currencies, to the currencies that have been in place, but also potentially for governments, also a huge opportunity. What do I mean by that? Well, right now there are a lot of companies that are scrambling to get ETFs out there that are linked to Bitcoin, that track Bitcoin, right? Well, with that comes investing. With that comes taxation, which would benefit governments. We see platforms like PayPal, banks.
Coinbase.
Banks are stumbling over each other. Yes, Coinbase, all these platforms which allow the trading and the transactions of cryptocurrency, all of that lead to taxation. Banks, I just mentioned. Banks are crawling over each other, trying to get their regulatory platform in place so that they can service cryptocurrencies and Bitcoin and Ethereum for their clients. The clients are going to hold them somewhere else, right? Might as well be the banks.
Right.
So they're doing that. The vendors, people who receive the cryptocurrencies. So all of this, in many ways, while there's a threat, it also potentially leads to more. Anytime you have innovation, with that innovation
comes disruption.
There's a lot of things that can take place that we're just unknown yet.
Creative destruction is
progress.
the official. Yeah.
Yep. Yep. Exactly.
Yeah. I think
it's a thin line we must walk, isn't it?
Right. I think the process that if I were a betting man, would probably bet that the way that they would regulate is regulate the exchange, or not the exchanges, but the platforms on which it was traded. So more strict regulation for a company like, let's say, Coinbase, on how, like, for instance, this isn't what's going to happen, but this would be something similar where on Coinbase you would have to fill out more paperwork to create an account or more paperwork to send it, and it would increase the friction, kind of. I would imagine that world where that's the type of regulation that we pursue. I don't think that we would outright ban it, and I don't think I mean, it's hard to predict, and every time you predict you're going to be wrong, but it's really difficult to regulate. Like, if people with their private wallets, like if you have your wallet on hardware, it's like, I can't even imagine a world where the United States government, without taking the hardware, that you could regulate that. I maybe, do you want to step in here, because I can't really think, I'm not that creative, I guess.
No, and I'm not either. I just we're in such a new frontier with this that I think that, but I think you can rest assured. I think Terry Cohen is right. There are very smart minds right now who are trying to figure out how we get a piece of this cryptocurrency as a government, and maybe for security reasons, control it a little bit more. Whether the control is the right word, I'm not sure. Like you mentioned, maybe it's the platforms to make sure it's just a legit process, that people are paying taxes on gains, everything is reported.
I mean, ultimately, the United States government won't decide if Bitcoin is a thing. The market will decide if Bitcoin's a thing. And if we want to take like the backseat approach where we harshly regulate and don't allow citizens to, I'm speaking as the United States government, and we don't allow citizens to transact and use Bitcoin and hold Bitcoin, the rest of the world probably will carry on to do so, because, like we've said before, I think it's a superior system, especially considering deflation or inflation that might occur over the coming years with all of this increased liquidity and from the past year, really, from 2020.
Yeah, I enjoy when you speak as the United States government.
Yeah, just imagine how messed up things would be if I was actually the United States government.
It could be worse.
Are you ready for your? Hold on. Are you ready for your surprise? Okay.
Yes.
So I said this before, but I got your Christmas present back in, I forget when I got, so it was back in November, and it just got here last week, and then I went home for the weekend. I drove through Ashland, and I forgot it. I was going to give it to you, but I forgot it, so I'm going to show it to you right now.
We're going to do this on air, huh?
I didn't tell you this.
Okay.
This is a blind side. Sorry, fill the dead air, because people are listening to this.
Well, I'm a failure here, because do you know why I'm a failure? It's because I've been meaning to use the word SPAC daddy.
Oh, there you go.
This whole podcast, and I couldn't fit it in. And the opportunity came, and I realized I didn't.
All right, this is the incentive to get on YouTube, so you can see what's going on here. All right, you ready?
Yep.
Check that out.
Who am I? Who am I in that
I don't know,
picture?
some sort of military general guy.
That's fantastic. I'm going to have that framed, and I'm going to put that on the wall.
Yeah.
Wall behind me.
There you go.
How about that?
That was my idea for it. It would be.
That was worth every delayed second.
I should take a screenshot of all the times that they tried to deliver it to the office and failed to do so. Apparently, our office is
amazing.
Impossible to get to.
Well, Merry Christmas,
Yeah,
Derek.
Merry Christmas in, was it April or May, or I don't know. My months are messed up.
It's always Christmas in your heart.
Yeah. By the time this podcast gets released, I will have a bachelor's degree in economics and a minor in philosophy.
Nice.
Right.
Congratulations. Well, Derek, on that, let's take us away after you grab your sip.
Yeah. As always, thank you guys for listening to Dynamic Growth. If you like the podcast, rate, review, and subscribe wherever you get your podcasts. Check us out on YouTube. The YouTube channel is Crosby Advisory Group. I will be posting links to the YouTube channel on the Instagram, which is Dynamic Growth Pod. And we will see you guys next week.
Derek, can I ask one favor?
Yeah, go for it.
You do a great job of posting the links, or I should say little clips of our podcast on Instagram. Yeah. Some of the listeners have asked if we could get them on the Crosby Advisory one as well.
Yeah, no problem.
Can we do that as well? So I know some people when they're following it through their feeds, maybe the one comes up more than the other.
Yeah.
And so we'll do our best to add that to both of
Gotcha.
those.
No problem. It's going to happen.
All right. Please remember, Crosby Advisory is a registered investment advisor in the state of Ohio and Florida. At any time, you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I may have mentioned specific securities or other investments, and please understand that's not a recommendation for you to go out and purchase those investments or sell them. Do your own homework. Make sure every investment that you own is suitable for you. Crosby Advisory is also a licensed insurance advisor. Insurance products are sold and serviced through Crosby Advisory.